Okay, so this analysis report tackles the massive SMX stock rally head-on. It's providing a really critical view, focusing on this idea of a dilution trap, driven by outstanding warrants and some recent corporate financing moves.
Right. And I think the counter-narrative approach is strong. It gets right to that core question, is it too late to buy SMX? It gives you an answer right away.
It does. And that high-value information, especially around that 528 warrant danger zone, is a great starting point.
It's a great foundation, absolutely. But for that conclusion to really land, for it to feel undeniable to a smart reader, we need to do more than just identify the risk. We have to quantify it.
I agree. Let's start with what I think is the most powerful component right now, which is the warrant overhang. The report makes it clear there's this risk from warrants exercisable at, 528?
Yeah, which creates this massive hidden selling pressure when the stock runs to something like $25. It just crushes the squeeze.
So here's our first point. The analysis should statistically quantify the magnitude of the warrant dilution risk to transform the danger zone from a theoretical warning into a concrete market-moving threat.
Exactly. It needs a number.
Okay, but let me push back a little. The report does identify the strike price. It shows the 400% profit mechanism, buy near 5, sell at 25. Isn't that enough to signal the danger? Why do we need the exact volume?
Because without it, the threat feels abstract. It feels big, but not measurable. So the weakness here is that while the mechanism is crystal clear, the report never specifies the volume of those outstanding warrants, the SMX-WS.
The ones from the SEC filings?
Right. And without that number, a reader can't really gauge the size of the dilution. I mean, is it big relative to the low float or the 36% short interest? We don't know.
So if that volume is only, say, 10% of the float, it's a concern. But if it's 100% of the float...
It's a ticking time bomb. It's a totally different story.
Okay, that makes sense. So without the scale, you can't properly assess the risk-reward of chasing that squeeze. The selling pressure is hidden, and you're saying the report needs to hand the reader a flashlight?
A very bright one. And the suggestion for improvement is really simple. Integrate that specific data point. Find the total number of exercisable warrants and put it right in the report.
So you shift the argument from just warrants exist to this is exactly how many shares can be printed right now.
That's it. That's the move.
And how would you frame that to really drive the point home? What's the most impactful way to present it?
Well, you don't just state the number. You have to frame it. You find the total number of shares that can be created, and then you say something like, the warrant overhang represents X million shares.
Okay.
If exercised, this new supply is equivalent to Y days of the average daily trading volume, or Z% of the current float.
Oh, that's powerful. You're translating a balance sheet number into something that a trader on the floor immediately understands.
It makes the hidden pressure tangible. It makes it urgent. You're basically turning a theoretical risk into a numerical reason why the stock just can't sustain that price.
Excellent. So we've quantified the threat, but let's move on. That volume, it's a fundamental data point. The report also has these really clear technical levels. There's resistance at 25, and that critical support, the gap fill, at $9.18.
Right, but they feel separate. The technicals are over here, and the fundamental warrant risk is over there. They aren't connected.
And that's our next point. The report would create a more compelling and unified thesis by structurally linking the fundamental anchor of the warrant strike price, 528, to the critical technical support level, 918.
It needs to be one single coherent story.
That's an interesting idea. I mean, 918 is a classic technical gap fill. When a stock breaks that, we know sentiment is collapsing. But is it really fair to say a fundamental mechanism, like a warrant contract, dictates a technical price move? Isn't TA all about market psychology?
It is. Until it isn't. And that's the weakness here. The report treats 918 only as a psychological level. It's where the rally started, fine. But it misses the chance to reinforce why a drop below that is so likely.
Okay.
When a short squeeze fails, psychology gives way to, well, financial reality. That 528 warrant strike is mentioned, but it needs to be integrated as the ultimate, the fundamental floor that takes over once the hype dies.
I think I'm following you. So you're saying 918 is the psychological breaking point?
Yes.
And once that breaks, the market is forced to look for the next logical valuation point, which just happens to be that institutional risk-free profit zone down at $528?
Exactly right. That's why my suggestion is to add a conceptual bridge, a transition between the technical breakdown and the final verdict that shows the real incentive at play.
So explain that once the hype fades and technical support breaks, the valuation is just, well, anchored to that warrant mechanism.
Right. And that's where the selling pressure would just accelerate because the supply becomes almost infinite all the way down to that floor.
That definitely elevates the analysis. You're going from just predicting a drop based on charts to arguing that a drop below 918 is almost structurally inevitable. The incentive is just too great.
How would you phrase that, though, to make it really clear?
Well, after you discuss the 918 support, you could add something like, if 918 fails, the market has rejected the hype and must now contend with financial reality.
I like that. Contend with financial reality.
The only remaining valuation anchor is the 528 warrant strike, making the path down structurally easier as long-term dilution holders gain absolute control of the supply side.
That's perfect. You're connecting the trading floor to the balance sheet. It makes the risk feel less like a possibility and more like an inevitability. It's contractual, not just psychological.
Exactly. Okay, let's move to the verdict. The report makes this really sharp distinction. It says, uninvestable for investors, but tradable for traders.
Which is great clarity. I love that.
Me too. But the rationale for the uninvestable part relies mostly on historical context, past dilution events. I think we can make that case even stronger.
I agree. So the third point, to solidify the uninvestable for the long-term verdict, the report needs to elevate the history of dilution from just background facts to a core, critical assessment of management strategy.
Now, I want to be careful here. We're looking at a history of events, right? There was that 1-for-8 reverse split in November, the increase in the incentive equity plan. How do we responsibly interpret that as an ongoing strategy? We can't really know what's in management's head.
We can, but we can analyze their actions. And the weakness is that the report currently lists these things as isolated risks. It's like a checklist. Here's a reverse split, here's an equity plan, but it doesn't connect the dots.
It doesn't interpret the pattern.
Exactly. It doesn't interpret what that sequence implies about the company's reliance on, equity sales to stay afloat, the timing, the combination of events. It suggests they are preparing for future capital raises by printing shares into any excitement. It's about intent, not just consequence.
So the historical record, when you view it all together, starts to look like a modus operandi, a playbook.
That's the suggestion. Analyze that documented history, the splits, the new shares, as a sustained pattern of behavior. It's evidence that the company's main strategy is to raise capital by issuing shares into rallies.
Which by definition erodes long-term shareholder value.
Fundamentally, it makes any long-term investment structurally flawed, regardless of whatever Dubai gold news might pop up. The dilution is the business model.
That framing makes the uninvestable verdict so much stronger. It moves beyond just valuation and into the governance risk of the company itself. How would you phrase that to really hit the point about intent?
You could say something like, the combination of the recent reverse split and the massive 7 million share incentive plan authorization indicates a deliberate and ongoing corporate strategy.
To use equity printing as a primary financing mechanism.
Exactly. This strategy fundamentally destroys the viability of any long-term valuation calculus for investors, turning management into a machine that simply monetizes every retail rally.
And guts long-term shareholder value in the process. Wow. That gives the verdict some serious weight. It's a powerful warning that even if the stock survives this squeeze, the financial structure itself might be toxic for anyone with a timeline longer than a few weeks.
And that shift in focus aligns the conclusion perfectly with the critical tone the report already has.
This has been incredibly focused. So, to recap, the analysis is already excellent, but we can amplify its impact through precision and better structural connection.
Right. So the 3 takeaways are clear. First, integrate the specific volume data for the warrants. Quantify that hidden selling pressure.
Turn that theoretical risk into a hard number.
Exactly. Second, formally bridge that gap. Link the technical 9.18 support directly to the fundamental 5.28 dilution floor.
Make the breakdown feel like a financial inevitability, not just a prediction.
And finally, use the company's dilution history, the split, the equity plan, not as facts, but as evidence. Evidence of a damaging, long-term corporate financing strategy.
To build that undeniable case for why the stock is structurally uninvestable for a long-term holder.
Do those 3 things, and you've got a killer report.
Applying these changes will transform an already strong report into a truly market-moving piece of analysis, providing a definitive answer for anyone asking if it's too late to buy SMX.